Yeah.
3, 2, 1? No? The 3, 2, 1 today?
3, 2, 1. Not feeling it.
We're not going to WOD today?
Not feeling CrossFitty today.
All right. Fed week. It's been quite the week. A lot of volatility. We're going to talk about a whole lot of things, but Wednesday, we're sitting there watching the Fed meeting live on Bloomberg, and the market pretty much wasn't doing anything on Wednesday, and then they came out and said it was a 50 basis point cut. Everything ripped to the upside. Mm-hmm. Stays that way for about half an hour, and I want to say Greenspan. Jesus. Powell comes
Show your age, man. It's been a while.
Yeah, a while, yeah. Powell comes out and says a very, very dovish press conference. Like, he did everything but take a victory lap. And they actually asked him at one point if he was mission accomplished. They, referred back to the mission accomplished thing and all that, and he kind of chuckled a little bit. He's like, no, I don't want to call it that, and whatever. It was everything he could to say we win, right?
Yeah. And
then the market rolled over. I mean, I was if he had said, if he was hawkish, if he had been like, yeah, we're doing 50 basis points, but particularly if we're doing 50 basis points because we see these things in the numbers that have us concerned about the economy going forward. That's not what he said. If he had said that, then it would make sense the market would roll over. That's not what he said.
Yeah, no, it was strange.
Yeah, it was really strange. And then, of course, Thursday, all the reversal from Wednesday came ripping back up and closed really high and outside of all these ranges and everything on Thursday. So, yeah, a ton of volatility. And it's going to be interesting to see, we still got until the middle of October seasonality-wise.
Yeah, and I'm really counting until after November.
Yeah.
To the election. Yeah. Get past that, and then hopefully things will start. I don't know what normal is, but
I don't know either. I mean, I was watching on the news this morning. The Middle East is firing up in a big way over the last week or two, but it's just going more and more today.
Firing it up is probably not the best terminology.
No. Sorry if you're can't get away from the background. Anyway, TSP Weekly Podcast, 22 September 2024. So we did a little bit of what happened this week. We're going to do something a little bit different in this section, so you guys are going to have to bear with me. Hopefully we don't have any tech issues, but I wanted to show you this one website. Then I got a little thing on what exactly the Fed funds rate is. So the Fed, everybody says the Fed lowers rates, the Fed raises rates. All the Fed does is move a thing called the Fed funds rate. And we're just going to talk about what that is exactly and what it affects, but not what it controls. And there's a really good app that if you have any interest in any of this stuff, it's called Economy Now. And we're going to talk about that with respect to GDP because GDP was increased this week, which is a big deal. And then I got one kind of one-off Facebook question and TSP charts. So what happened this week? Monday, we got New York State Manufacturing Index jumps up to 11. So what exactly does that mean? This is all coming from Trading Economics, and that's the website I'm going to show you guys in a minute because if you have any interest in the macroeconomic and fundamental numbers all in one place, this is a great website for it. So New York Manufacturing Index unexpectedly jumps to 11.5 in September, highest since April of 22 compared to a negative 4.7 in August. So a huge move higher, right? The reading shows business activity in New York State grew for the first time in nearly a year. As new orders climbed, shipments grew significantly, delivery times and supply availability were steady, inventories leveled off. Meanwhile, labor market conditions remain soft, with employment continuing to contract modestly and the average work week holding steady. Also, the pace of input and selling price increases were a little changed. So firms grew more optimistic that conditions would improve in the months ahead, though capital spending index dipped below zero for the first time since 2020. So basically what the takeaway from this is manufacturing. This is one of the key Fed metrics, but obviously the economy is doing well if the manufacturing index is increasing. And so this was COVID, right? We had a big decline in manufacturing because nobody's going to work. And everybody goes back and manufacturing is good, right? 2022, 21 into 22, we got that recession and it dipped and it never, the stock market is back up here at new all-time highs, but manufacturing never got there. And then we had another little dip, but now it looks like, we're pointed back higher. So it's definitely bullish for the economy, right? The manufacturing index is turning back up, so that's a good thing. Okay. On Tuesday, so that was on Monday, right? On Tuesday, retail sales. So retail sales are a big indicator of what consumer spending is going to be like, right? Month over month, we're down, but they were much better than expected. And manufacturing production, both month over month and year over year, were up. Also bullish, right? Wednesday, housing market index rises for the first time in 5 months. Building permits and housing starts were both up significantly, right? And then also on Wednesday, we got the Fed 50 bips cut and the press conference. We'll get to that in a second. So this housing index had been declining for 5 months and had a big uptick in September. Okay. Obviously, housing is a big one. So the Wells Fargo housing market index rises to 41 in September from 39 in the previous month, and the forecast was 40. So it breaks a string of consecutive monthly declines. The gauge for current sales conditions rose 1 point to 45, yada, yada. So this is kind of the big takeaway for me. Meanwhile, the share of builders cutting prices dropped in September for the first time since April. So the only way builders were getting people in to even look at buying houses, if they could afford the rate, was to drop prices. And so this is the first month that they stopped doing that. So rates are coming down. 30-year mortgage rates are coming down. Builders are giving less incentives. So the housing market should start to move, right? As long as unemployment doesn't tick up. So all these things that the underlying economy is starting to turn, right? Manufacturing is getting better. It looks like the data is showing that things are starting to turn. It does not support the idea that we have a recession imminent, okay? So all this stuff is really bullish. Then all that happened this week before the Fed policy announcement, okay? Then Thursday we have initial jobless claims, 219,000 versus 231,000 last week, but they had forecast for 234,000. So there are less initial jobless claims than they expected. And then the 4-week average also fell, right? Then we get the 30-year mortgage rate falling to 6.09 from 6.2. Once this thing gets to be a 5 handle, 5.99, that's going to change the makeup of the housing market, I think. And I think what's going to be interesting is whether or not prices go up as people start to clamor to get a rate in the 5s. The rate had peaked at 7.76 back in November of 2023. And then today on Friday, there's really no significant economic news. But let me just try to do this because let me just go to this. So this is the tradingeconomics.com calendar, right? So if you go to tradingeconomics.com /calendar, this is what you get, okay? So where it says this week right here, you can hit that drop down and it'll give you, you can look at data backwards and forwards. But I always just do this week, and I start on Monday and look at the things that are happening that are going to be important, right? We talked about that New York State index. The actual was 11.5, right? And the previous was negative 4.7. So I thought that was pretty cool. You hit on that link, and it brings up, the information and the chart of it. So you can see manufacturing has been increasing, right, since the beginning of the year. But this is the first month that it really, really ticked up. It's definitely bullish, right? And the only other one I'll show you, because you can go through all these. So you go day by day and look at the ones that either interest you or that are going to be important to the market. The 30-year where's the one that I This one, 30-year mortgage rate, okay, that came out on Thursday. It dropped to 6.09 from 6.2. But if you look at the chart of it, right, that gives you the kind of a clip of the chart. And then you can zoom it in and look at, like, there's a 5-year chart of mortgage rates. So you can see they're kind of falling off a cliff, right? You got a head and shoulders, actually, head and shoulders top in mortgage rates. I mean, are they likely to get back down here to, 3% like they were back here in 21? Who knows? Probably not. But you can play with the charts here and look at it and go back here in 1982. Mortgage rates were 18%. And they've been falling consistently for the last 40 years as housing prices have gone up. So if rates continue to go, so they're coming down now, but if they continue to go higher, because it looks like this is the beginning of a interest rate hiking cycle, probably not just a one-off, but we'll have to see. So anyway, a lot of good information on the economic calendar, so you definitely want to check that out. All right, and that seemed to work. Very good. Okay. So what exactly is the Fed funds rate? So a lot of questions about what that is. This is a really good article from Forbes that kind of summarizes it. And I'm just going to go kind of through the highlights real quick. But Fed funds rate, I'm not going to read all that. Fed funds rate.
You had me worried for a second.
Fed funds rate, it's a really important tool that the Fed uses to guide monetary policy. It impacts, it doesn't cause, it impacts everything from the annual percentage yield that you get on your savings account to what you pay on credit cards. And it means the Fed funds rate effectively dictates the cost of money in the U.S. economy. That's the headline, right? The FOMC is the Federal Open Market Committee. They're the ones that set the Fed funds rate. The Fed funds rate, it's a guide for overnight lending among banks. Okay, that's what it is. So they set it at a range, and it had been at 5.25% to 5.5%. And after this 0.5% move that we had, now the Fed funds rate range is 4.75 to 5%. So what it affects is banking. So customers deposit money at a bank. Those deposits provide bank with the capital that they need to extend loans and other credit to other customers, right? Some people make deposits, other people make withdrawals or credits, and the bank has to balance that throughout the day. And at the end of the day, the regulators require that banks and other depository institutions keep a certain percentage of their total capital in reserve to guarantee the stability or solvency of the bank, right? So we don't have banking crises. So to make sure that you're within the range for the regulators, banks have to borrow money from each other, right, overnight. So they call it the overnight lending rate. That's the rate that the banks lend to each other. Okay, so when the Fed raises or lowers that rate, that's all it's doing. It's raising and lowering the interest that banks have to pay to each other if they need to borrow money, right, just to make those capital requirements for the regulators. That's really all it is. But when the Fed raises the Fed funds rate, what it's really trying to do is boost short-term. When it raises rates, it's boosting the short-term borrowing costs throughout the economy, right? Because if the bank has to charge, one bank has to charge another bank more of a rate, that gets pushed off to the customer. So as the Fed funds rate goes up, the cost to borrow, if you want to borrow money from the bank, goes up. And that affects credit cards and loans of every kind. But it's not directly attached to them. It's only directly attached to the Fed funds rate. Okay, so when they lower the Fed funds rate, it has the opposite effect. It reduces the short-term interest rate throughout the economy, increasing the money supply and making it cheaper to get credit. Right. So this can cause moments of lower negative inflation. I mean, it all is affected by the Fed funds rate, but it's not exact. It's not like when the Fed lowers the Fed funds rate by 0.5%, your mortgage rate is going to go down by 0.5%. Well, your credit cards are going to go down by 0.5%. It affects that, but it's not a one-for-one. Okay. Hopefully that helps a little bit in getting the idea, because everybody's like, I thought when when the Fed lowers rates, or when the Fed, lowers rates, the F fund goes up. Generally, that's true. It's just not a one-for-one. During a Fed rate cutting cycle, bonds go up because the yield on the bonds goes down. But it's not one-for-one. Day-to-day, one-for-one. It's not like that. It's not cause and effect. Does that make sense? Kind of. All right. Economy Now app and GDP. So that one website, the economic calendar is really good. If you are into this stuff at all, which hopefully you guys aren't into it nearly as much as I am, but this is an app. It's called Economy Now, okay? And this picture is kind of cool because it does a pretty good job of showing the important things. It does macroeconomic stuff, the estimate, right? The GDP estimates going forward, stuff for the labor market, inflation, right? So obviously this is just a picture of the
I find it pretty interesting because you can click on that and it goes deeper.
Yep.
And it's basically taking you to a lot of information that is also on their website.
Yep.
But you have to kind of dig around for it. And this puts it all kind of right there. Yep. And the most recent. I mean, you're definitely geeking out if you're getting into this kind of, but I love it. It's got macroeconomics and, it's all sectioned. It's a really good app.
It is good.
Especially if you're trying to look for this kind of stuff that you're like, okay, these guys are always talking about the GDP this and the numbers for the housing market and all this. And like, where do you get all that? And you're like, well, this is the kind of places and you can get it really easy. Yeah. So I find it pretty handy. I don't look at it very often, but I do when something piques my interest for sure.
Oh, I have notifications on for it. And
of course you do.
so the other day when it popped up and it said the new estimate for third quarter GDP is up from 2.5 to 3. And I'm like, there's no way.
It can't be.
It can't be. It doesn't matter what I think.
But it is.
But it is.
Yeah.
So, okay, no recession. Like, it's GDP and unemployment. And the last unemployment number went down from 4.3 to 4.2, and GDP just went up from 2.5 to 3. That it's all bullish. There's no. I mean, will we get a recession at some point? Almost definitely. It's not happening this year. But that's a good app. Definitely check it out. So there's an article that kind of related to it. So it was from September 18th. I can't remember if that was the day the Fed was cutting rates or the day before or the day after. But so Fed prepares for the first rate cut, but is it too late, right? We've talked about this quite a bit. The question is, has the Fed kept rates too high for too long, already causing a recession, right? So Ed Yardeni, we've talked about him before. He's usually very bullish, but very good analyst, been around forever. He calms recession fears, according to this headline, amid strong data. So a lot of this is what we just talked about from that one website, right, from the economic calendar. So even as the Federal Reserve prepares to announce its first rate cut in monetary policy, like we said, people have fears that the move could be a little too late to keep the economy from slipping into a recession. Yardeni isn't too worried about that, right? So the GDP Now app, right, that's what they're talking about. The Fed Reserve's GDP Now, that's the app we just talked about. That model revised its estimates for third quarter real GDP from seasonally adjusted 2.5 to 3%, right? That means the economy is growing, it's not shrinking. A recession happens when the economy is shrinking. The growth pertains to the national economy. Yardeni noted that upward revision was made following the release of solid August retail sales and production reports, right? That's what we just talked about in the economic calendar website. Like, you can see all this stuff happen, and all that happened before the 50 basis point cut. Separately, the Fed said industrial production rose 0.8, right? Production is up, even better than forecast. He notes that an upward revision in real consumer spending growth from 3.5 to a whopping 3.7, primarily responsible for the upward adjustment in the GDP Now model. So all of this is bullish, right? All of this is bullish. And this is before the Fed cuts the 50 basis point rate. So basically everything is bullish at this point. That doesn't mean the market's going to go up every day. It just means that the concerns about economic slowdown, and there's still plenty of data points out there. You'll hear, people on CNBC and everywhere else talking about different data points, but until unemployment starts really ticking up or GDP starts coming down, in general, the trend ought to be up. And it could, depending on who you watch and who you follow, there are a couple guys out there that are calling for 7,000 on the S&P by the end of the year. Yeah. All right, so kind of a one-off Facebook group question. Quick question for the group. Is TSP federally insured? Interesting question. The answer is no, but I'm not sure exactly what the question goes to. So obviously, like FDIC is the entity that insures your deposits in banks, right? So if the bank was to go down, right? If there was a run on the bank, and like what happened with the banking crisis we had there in March 23, I guess, and there was another little one in 24. But when there's a run on the bank, if the bank closes or merges with another bank, your money in there is federally protected. The federal government self-insures, so there isn't going to be a takeover probably of the federal government. So there's no insurance against losing money in the TSP, right? If you're in a fund that goes down, the government isn't going to insure your losses because you're in a fund that goes down. If that's what that question went to, I don't think it goes to that. But is TSP federally insured? The answer is no. But on the other hand, the government self-insures. So, yeah, I just thought it was kind of an interesting question to pose and kind of talk about a little bit. Okay. TSP fund charts. So this was the chart of the C fund that we put up last week. This is a weekly chart where each tick is 1 week of price movement. The blue line is the 20-week moving average line, and this is the relative strength indicator down here. So the green horizontal lines are a Fibonacci extension tool. So we started at the top in January 2022, and we went to the bottom in October 2022. And so we used the Fibonacci tool to extend out and give us price targets. Okay, so the 1.618 is the most common extension level where we would expect to see resistance and or a reversal in price. It's a really important extension level. Okay, so what happened? We got 1, 2, 3, 4, 5, 6 weeks of banging up against that extension level, right? So we got resistance there, going all the way back to like the first week of July. Okay, so we definitely got resistance there, and until we get above there on a weekly close above there, the risk is definitely there that we will not get through it and start back down, right? And we also had relative strength. This was the peak in relative strength, which was this peak right here. As price kept going higher, we actually had a lower high in relative strength. And then as we hit it again, we had another lower peak in relative strength. So the momentum was waning behind that move. Doesn't mean it can't reverse, right? It's just that as of last week, the momentum was waning. If we flip to this week, now this is as of the close on Thursday. So Friday, the market's down a little bit as we're doing this at about 11 o'clock. But if we close the week above this green line, we're in really good shape, especially since we're just coming out of a lot of consolidation right there. We got a breakout to the upside. We're in really good shape. Okay. So it's definitely a bullish week. S-Fund, same kind of thing. S-Fund has a lot of room to go because we're nowhere near the prior high, which was back in late 2021. But we've been in this sideways consolidation for most of 2024, and we just broke out of it this week. So if we finish there for the week, again, very bullish for the S-Fund. And iFund, we've been talking about this triple top at 82. Couldn't get through it. Reversed right there, and that started the 2022 bear market. We got back up here, and we've been hitting up against that 82 level for months as relative strength has been declining, right? So you need some power to get through that resistance level, and we really haven't seen it. As of Thursday's close, it looks like we're going to end the week above that level, but actually today, as of 11 o'clock or so this morning, the iFund is back down basically to that 82 level. So I would not call that as confirming of a new uptrend as I think we have in the C and the S funds. And then the F fund is still a very safe place to be, right, for now. It's we had an initial target at 103. So it'll be interesting to see if we get up to 103 and we're still in this soft landing kind of scenario. The F fund could roll over from here if we did a 50 basis point cut and then stayed there and held that level for a while. Again, it's not a 1-for-1. What really matters for the F fund is if we do go into recession, because then the F fund moves. The Fed is cutting rates to put a floor under falling stock prices, and then that's when the F fund does really well. All right. Questions? It was quicker than I thought, but there's a lot of good stuff in there.
Yeah, it was a lot of stuff.
Yeah.
Hey, if you guys have any questions, you can always hit us up on in the comment section wherever you find this video. And if you like this stuff, share it with your friends. We get most of our kind of new folks in this by word of mouth, right? Mm-hmm. So tell your buddies. Hey, I mean, I don't know any other shows that do this kind of in-depth analysis of the market for the TSP, but if you know about it, tell me, because I'd like to watch too.
Yeah.
All right, hope you guys have a great week, and we will see you next time.
Week. Out of here.